Ever wonder what the pros are really looking for when a company drops its quarterly earnings report? It's not just about one big number. It's about decoding a story, finding the clues that tell you where a company is truly headed. Forget the headline hype. Today, we're diving deep into the art of analyzing earnings reports to uncover the real insights that can shape your investment strategy. This is where the smart money is made, by looking beyond the surface and understanding the narrative hidden within the numbers. Let's get started. So, you've got the earnings report in front of you. It can feel like a mountain of data, right? Let's break it down into manageable, crucial pieces. First up, the income statement. This is your primary battlefield. The two numbers everyone talks about are revenue and net income. Revenue, or the top line, tells you how much money the company brought in. Is it growing, shrinking, or flatlining compared to the same quarter last year? That year-over-year comparison is key, as it smooths out any seasonal weirdness. A company that consistently grows its revenue is a healthy, expanding business. But revenue is just one side of the coin. The other is net income, or the bottom line. This is the profit left after all expenses, taxes, and costs are paid. You'll often see this presented as earnings per share, or EPS. This is what most analysts are trying to predict. Did the company meet, or miss expectations? A beat can send a stock soaring, while a miss can cause it to tumble. But again, don't just look at the number in isolation. Look at the trend. Is net income growing faster than revenue? That suggests the company is becoming more efficient and profitable. If it's the other way around, with revenue growing but profits shrinking, you need to ask why. Are costs getting out of control? Now, let's talk about the unsung heroes of the income statement, the margins. Gross margin is a big one. It's calculated by taking the gross profit, that's revenue, minus the cost of goods sold on, dividing it by revenue. A high or expanding gross margin means the company has strong pricing power and an efficient production process. If you see this margin shrinking, it could be a red flag. Maybe competition is forcing them to cut prices, or their raw material costs are rising. Either way, it's squeezing their core profitability. Then there's operating margin. This takes into account not just the cost of goods sold, but also operating expenses like marketing, research and development, and administrative costs. This margin gives you a broader view of the company's operational efficiency. A company might have a great gross margin, but if they're spending a fortune on marketing to get those sales, their operating margin will suffer. Comparing these two margins can tell you a lot about a company's business model and cost structure. Is it a lean, mean operating machine, or is it bloated and inefficient? To make this real, let's imagine we're looking at Apple's hypothetical Q for 2025 earnings report. Let's say they report record revenue, beating analyst estimates. Great, right? The stock probably pops. But we're going deeper. We look at the revenue breakdown. We see iPhone sales are up 5%, but Mac and iPad sales are down 10%. More importantly, their high-margin services division, things like the App Store and Apple Music, grew by 20%. This is a crucial insight. It tells us Apple is successfully shifting its business model towards more recurring, profitable revenue streams. The reliance on cyclical hardware sales is lessening. That's a powerful long-term positive that the headline record revenue might not fully capture. Next, we check their margins. Let's say their overall gross margin ticked up from 44% to 45%. That's a huge deal for a company of Apple's size. It shows they're maintaining pricing power despite competition, and that the growth in their high-margin services business is positively impacting the bottom line. This is the kind of detail that separates a casual observer from a serious investor. But the numbers in the report are only part of the story. The other part is the management's commentary and the subsequent conference call. This is where you get the color, the context, and the forward-looking guidance. What is the CEO saying about the next quarter? Are they optimistic or cautious? Listen carefully to the language they use. Are they confident and direct? Or are they using vague, evasive phrases? On the conference call, the Q&A session with analysts is pure gold. This is where management gets put on the spot. Listen to the questions the analysts are asking. They are often focused on the very same pain points or uncertainties that you should be thinking about. For instance, an analyst might ask, "You mentioned supply chain constraints in your prepared remarks. Can you quantify the impact you expect this to have on revenue for the next quarter?" The answer to that question could be more valuable than any number in the current report. It gives you a glimpse into the future. Pay attention to any surprises. Did management announce a huge new buyback program? That signals they think their stock is undervalued. Did they warn about a new competitor or a slowdown in a key market? That's a major red flag. To give us a pro's perspective, I spoke with a seasoned portfolio manager, let's call her Jane, about what she looks for. She told me, "The biggest thing I look for is a surprise, but not just the headline EP's beat. I look for surprises in the segment data or the cash flow statement. Did a new product wildly outperform? Did they generate way more free cash flow than expected?" These are the leading indicators. The other thing is the quality of the earnings. Did they boost profits through genuine business growth, or was it from one-time events like selling off an asset or a favorable tax adjustment? High-quality earnings are sustainable. Low-quality earnings are not. You have to read the footnotes to figure that out. That brings us to another critical document, the cash flow statement. Sometimes a company can look profitable on its income statement, but be bleeding cash. The cash flow statement doesn't lie. It shows you exactly where the cash is coming from and where it's going. Look at cash flow from operations. This should ideally be positive and growing. It represents the cash generated from the company's core business activities. A company with strong operating cash flow can reinvest in its business. pay down debt, or return money to shareholders without needing to borrow. It's a sign of true financial health. If you see a company with rising net income but falling operating cash flow, you need to investigate. It could be a sign that their sales aren't actually being collected as cash, which is a big warning sign. So let's recap the process. When an earnings report comes out, start with the income statement. Check the year-over-year growth in revenue and net income. Then dive into the margins gross and operating to assess profitability and efficiency. Look for the story behind the numbers. Use our Apple example. Break down revenue by segment to understand where the growth is really coming from. Don't forget to listen to the conference call for management's guidance and their answers to tough analyst questions. And finally, always cross-reference the income statement with the cash flow statement to ensure the reported profits are backed by real cash. Analyzing earnings reports is a skill that takes practice, but it's one of the most powerful tools in your investment arsenal. It allows you to build a conviction based on facts and fundamentals, not on hype and headlines. By going through this process, you move from being a passive market observer to an active, informed business analyst. You start to understand the very heartbeat of a company. Thanks so much for watching. If you found this deep dive helpful, please hit that like button and subscribe for more content to help you become a smarter investor. Let me know in the comments which company's earnings you're looking forward to analyzing next. See you in the next video.